Hello and welcome to Tax Update 22. I'm Andy Rainford, Chartered Tax Advisor and Content Editor here at Indicator. This week we make an important point about tax refunds going unclaimed, a new phone number especially for trust queries, and a crucial Supreme Court case regarding capital allowances. Individuals are being reminded to check if they are entitled to a tax refund through the pay-as-you-earn system. Those affected should receive a P800 calculation after the year end. However, as refunds are no longer automatically issued, they must be claimed. The quickest way is to use the app, though it can also be done via the personal tax account. Non-reimbursed homeworking expenses can no longer be claimed against employment income as of the 6th of April 2026. Previously, a deduction of £6 per week could be claimed. However, it is worth remembering that a claim for the previous 4 years can still be made if it hasn't been done already, so it is worth checking work patterns back to 2021 to 22. There is a new dedicated trust helpline, shown here, available to use for queries related to income tax, capital gains tax, or the trust registration service. For inheritance tax, the existing number should continue to be used. The main rate of writing down allowances fell from 18% to 14% from the 1st of April for corporation tax and the 6th of April for income tax. Where an accounting period straddles the appropriate date, a hybrid rate will need to be used. A new tool is now available to work the rate out, and you can access it at the URL shown here. This first case was heard by the Supreme Court, and as such is an important precedent for capital allowances. The company claimed capital allowances in respect of surveys that had to take place before offshore wind turbines could be built. The surveys were required, and capital allowances were claimed on the basis that the expenditure was on the provision of plant. The question was whether this type of preparatory work was closely connected to the plant. The court decided that it was not, and no allowances were available. This has significant implications for any business involved in large infrastructure projects. Hopefully, there may be reform of this area as a consultation is due. This next case concerned a gift of shares to a charity. Where a qualifying holding is gifted to a charity, a deduction against the taxpayer's income can be claimed. However, because this relief has been used in avoidance schemes, there are a number of controls to ensure claims are genuine. In this case, there was no evidence the taxpayer had ever owned the shares, that there had been a transfer, and that the charity was genuine. It was therefore easy to dismiss the appeal. The tribunal also held up the penalty for careless behaviour. That's it for this week's update. See you again for another one soon.
Thanks, Andy, and I'm looking forward to your webinar with Ed Thompson in June too. In the meantime, you can view our last one on our YouTube channel by visiting the link below.